Hey guys, my name is Mike Boyd, this is the Money Flare, and it's been a while. Last time I made a video, I was warning about some potential volatility in the markets, and boy did we get some volatility. I haven't made as many videos as I would like to over the past 2 months, and unfortunately that situation will probably continue for the time being. Recently, my workload at my day job has increased significantly, and I've decided to spend the rest of my free time to focus on managing my own portfolio and focusing on my trading, because this is the perfect market for traders at the moment, and so most of my efforts are spent pursuing that. But I did want to take some time to make today's video, which will be sort of an update on markets, what changes I've made to my portfolio, and where I see things going over the next few months. Keep in mind that this is just my opinion, and I very well could be wrong. I'm sharing my views with the hopes that someone watching could get some value from it. And I don't have a crystal ball and I can't predict the future, but I try to make decisions based on probability. And right now, I think the chances are quite high that this volatility that we've seen in markets will last for a while. So let's get into it. But before that, I wanted to go over 2021 in general, what I got right and what I got wrong for full transparency. I try to be more right than wrong, and luckily this has roughly been the case last year. My biggest thesis last year was that inflation would not be transitory and that you should ride the reflationary wave with a large overweight position in banks, energy, materials, and industrials. And for the most part, I avoided overvalued and unprofitable tech companies that a lot of other YouTube people love to talk about all year. I even made multiple videos where I said to be careful in these kinds of stocks. Stuff like Tesla, Neo, Palantir, Peloton, the general basket of stocks around the Cathie Wood ARK portfolio. I even used her own ARK Innovation ETF as a comparison to my own portfolio because, once again, my thesis was that reflation, energy and banks in particular, would outperform the rest of the market. And there were a lot of risks in investing in overvalued tech as a whole. And that view overall has been very right. And I'm glad I didn't suffer a lot of the carnage that these stocks experienced near the end of last year and especially the first 2 months of this year. Many of those stocks have fallen 70 to 80%. Peloton is down 86% from the high, Palantir down 76%, Neo down 72%, Robinhood down 86%, the list goes on. Only Tesla is sort of hanging in there, down only 32%, but I think that one will go too. The Cathie Wood Innovation ETF ARK as a whole is down 62%, and unfortunately I know a lot of people on YouTube, both viewers and creators, probably had portfolios that looked a lot like that. Overvalued tech, innovation, and meme stocks. But luckily, it's not just the small retail traders on Robinhood that are suffering the losses. Hedge funds are also feeling the pain. The most popular hedge fund long positions have suffered their worst 12-month return relative to the S&P 500 on record. So if the meme stock movement was about fighting back against the hedge funds, then consider it mission accomplished. Now, I don't mean to say I told you so to anyone who might be bag holding a lot of these stocks. My intention is never to mock or to insult anyone based on their investment decisions, even if it's something I disagree with. The ARK Cathie Wood style investing performed phenomenally in 2020, and for good reason. We had a massive liquidity-induced bubble from all the money printing that we did from COVID. And anyone who invested in that thesis was very right up until around mid-2021. And so there's nothing wrong with investing that way, but I think that at this point we can all agree that we were in a massive bubble that is now popping. And so I was right in avoiding most of those stocks, and I was right in being overweight banks, materials, industrials, and of course, energy. They all outperformed the market since the COVID lows. Energy in particular has been on an absolute tear lately. Things like Peabody Energy, which I talked about months ago, are going vertical now. But I was very wrong on many other things. First and foremost, cannabis and some of the other high beta stocks and sectors that I was interested in. A lot of those stocks got killed along with the Cathie Wood basket of tech stocks. And I was also wrong on Bitcoin. I, like many others, thought that we would see a larger peak going into the end of 2021, but that's not what happened. It hasn't fallen further, but I don't expect it to make new highs anytime soon. So overall, 2021 was a good year for markets in general and for my portfolio. I definitely could have done better to reduce some risk back in November, but I'm sure many of us are saying the same thing right now. But now we find ourselves in 2022, and only 2 months in, it's looking like it'll be another crazy volatile year. My thesis for markets has changed drastically this year, and I want to take some time to explain what I think might be in store for us. To be brief, I think this year will be very bad for asset prices. The last video I made went over a few of my fears, and while I may have been a bit too worried about Omicron, I wasn't wrong in being worried about the changing monetary dynamics, and that still remains my biggest thesis for this year. And that is that after injecting more stimulus into the global economy in response to the COVID crisis, like we've never done before in history, right? The sheer size of the stimulus that we did dwarfs even the New Deal from the Great Depression. So after all that liquidity was pumped into markets, sending stocks soaring higher, We are now about to pull back that liquidity and tighten monetary conditions at the largest pace we've ever seen. And most importantly, we will be doing this at a time when economic growth appears to be slowing. And this will be very bad for asset prices. And with inflation the highest it's been in 40 years, central banks around the world won't be coming to the rescue this time. I think a lot of investors will be caught off guard. We've already seen the market take a tumble after the Fed just announced it was increasing interest rates and doing QT, which is quantitative tightening, the opposite of money printing. Instead of buying assets, the Fed will start selling assets. So they haven't even done anything yet. Just the mere mention of it has spooked markets. Tech stocks have crashed. Even large stocks like Facebook and Netflix have dumped. When an $800 billion company like Facebook loses $200 billion in valuation in a day, you know that's not a healthy market. Only Apple and Microsoft have held on so far. And this is coming at a time when economic growth is looking like it's peaking. The non-manufacturing PMI is rolling over and real wage growth is negative. So because of inflation, US consumers are losing purchasing power in a big way. Add to that the very difficult comps and the recent rise in oil and commodity prices, and you have a recipe for decelerating growth. But where I think a lot of investors are wrong is in assuming that the Fed will stop raising interest rates and start doing QE again as soon as markets start falling. That they're going to come to the rescue like they have many times before. We've had the infamous Fed put ever since the late 90s where asset prices have been propped up by easier and easier monetary policy. But a key thing to remember is that inflation over the past 20 years has been very low. And so the Fed was able to support markets only because inflation was so low. But now inflation is at 7.5% and it's looking like this will be structurally high inflation. High inflation for much longer than we expect. I've already made a video on my views on inflation and most of my views haven't changed. I think inflation will be high for longer and supply chains aren't getting better, they're actually getting worse. And with oil prices and energy prices through the roof, those increased costs will spill over into so many other prices, food prices especially, and we've already seen the food price index surge to new highs. And inflation hurts the poorest the most, people whose disposable income is much more affected by raising gas prices and food prices. And because inflation hurts the poorest the most, there will be very little desire to save stocks this time. The social unrest we would see would be good for no one. So letting inflation run hot and saving stocks at the expense of the poor just won't fly. And in fact, no one should be calling for that. So don't fight the Fed are very wise words, and it works in the reverse too. So they will be increasing rates and they will sacrifice stocks if they need to. The only way to bring down inflation is to send us into recession by tightening monetary policy, and I think that could very well be likely going forward. The main problem we have now is a real resource problem, mainly energy and agricultural commodities and industrial metals. I talked about this during my video on energy. And even if Elon Musk is tweeting about how we need to increase oil and gas output, then we have a real problem. We have such fragile supply chains and energy infrastructure that needs to be rebuilt. But that will take time. It will take years. And this era of deglobalization, reshoring supply chains, and very low supply of commodities is very inflationary. That's not transitory. The Fed can print money all they want, but they can't print oil or copper. And that's the real problem we have, and that will take years to fix. And raising interest rates won't change any of that, but raising rates would bring us into recession. And so if our issue is low supply, then the only way to solve that issue and bring down prices and inflation is to lower demand. And so that means recession. So that's my main thesis. I'm not sure if we will be seeing recession soon, but I do know that this environment of tightening monetary conditions with slowing economic growth is very bad for stocks and asset prices as a whole. And the Fed won't save us. Now, don't get me wrong, I do think that eventually we will go back to printing money and QE, and so the Fed will step in to save stocks, but that is probably much lower than many people expect. And I'd rather avoid those losses if I can. And so that has been my thesis for a few months now. Probably since December is when I started changing my views. But one thing that I didn't expect was war in Europe. And the Russian invasion of Ukraine, along with the crippling sanctions that we've imposed, what that means for commodity and oil prices, that makes all the points I just brought up much worse. The international response to the war has been ferocious. Russian banks have been removed from SWIFT, which is the interbank communication channel for making interbank transfers. Governments have imposed strict sanctions, and insane amounts of companies have already left Russia. Germany announced for the first time since the 1940s that it's increasing military spending, and most surprisingly, the assets of the Russian central bank have been frozen. This last event needs further explanation because its effects could last for decades to come. The US and its allies cut off the Russian central bank's access to its $630 billion of foreign reserves. So they basically cut them off from their US dollar savings account. And this is a level of US dollar weaponization that we've never seen before. And it could be the end of the US dollar as global monetary reserve currency. We could be witnessing the beginning of a bipolar monetary world where the US and its allies are on one side and China, Russia, and its allies are on the other side. Because now any central bank holding US dollars in reserves must hedge the possibility that they too will not be able to access those reserves. So it changes the entire picture more than any of us can imagine. The only sanction left is to ban the import of Russian oil and gas, which for most countries would be disastrous. Most of Europe imports their oil from Russia, and so cutting that flow off would mean much higher prices in the future. And this is already at a time when the dirty energy sector as a whole is starved of investment and production is sorely lacking. We've already seen oil prices surge 20% in a few days, and the European natural gas chart looks like a scam crypto coin. The strain this puts on the European manufacturing sector is immeasurable, and we'll soon find out the results. Worst of all is the food inflation that we'll be seeing coming out of this crisis. Russia is the third highest producer of wheat, and Ukraine is the seventh highest. If the war rages on past the end of March, which is typically the planting season for the next crop, then there will be no wheat planted. The situation was bad enough before the war, but it's much worse now. Food inflation has always led to social unrest and uprisings. We saw it happen in the Arab Spring in the early 2010s, and unfortunately I think we'll see it going forward. In the past few days alone, we've seen commodity prices surge higher. Wheat, lumber, oil, natural gas, industrial metals. As I said earlier, the food price index is at an all-time high, and that was before the effects of the war. And it's important to keep in mind that every 50% rise in oil prices have led to a recession, and we're seeing that now. The markets haven't been reacting well either. The Russian stock index plunged 45% in one day, the largest daily drop of a major stock index in history. The US markets also aren't taking the news flow too well. The S&P and NASDAQ are well off their highs, but not as low as I think they could go. Let me be clear, this is not a buy the dip BTD moment. This is a GTFO, get the F out moment. I could be wrong, but then again, no one knows what will happen. We've literally never seen this environment in decades, and most portfolio managers have never invested with this level of inflation and geopolitical risk. So I don't know what's going to happen, and so for me personally, I'm much more comfortable reducing risk and letting things play out. This is not a time to be betting big on certain individual stocks or to be speculating. This is the time to preserve your capital. So I've made significant changes to my portfolio, and I'll show you how I've changed the MF portfolio and how it has performed since December. Now, for anyone not familiar, I've been tracking a portfolio called the Money Flare portfolio, or MF portfolio for short. And it roughly matches what I'm doing with my own personal portfolio. And I'm doing this for transparency reasons so that anyone watching can decide for themselves if they want to have any trust in my views. So first, getting into performance. The MF portfolio has done very well in 2021, and especially over the past 2 months. From January 2021 up to Friday, March 4th, the MF portfolio is up 25.5%, while the S&P 500 is up 16%, and the Cathie Wood ARK ETF is down 51.6%. And since December 2021, the MF portfolio is up 0.6%, the market is down 4%, and ARK is down 39%. So I've been very happy that things like energy, commodities, and gold have really suppressed the volatility of my portfolio. But don't get me wrong, I've definitely made plenty of mistakes. For someone who was so bullish on commodities and energy, being up 0.6% is really not that good. I should have been up much more, but I took profits a bit too early in some stocks and in some commodities. So I really didn't expect war to happen, and so that was my bad. But now I've made many changes. I've sold all of my stocks except for energy, materials, and defensive stocks, which are usually a basket of consumer staples and utilities. The energy ETF XLE sits at a 7% allocation, and the materials ETF XLB is 5%. The defensive ETF DEF is at 10%, and energy in particular has gone up a lot recently, so I took some profits, but I'll be keeping a core position that I'll hold for the long term, and the same thing goes for materials. I'm also holding 11% gold in the form of the GLD ETF, 20% bonds in BNDD and TLT, 10% agricultural commodities with the ETF DBA, and a very small 2% allocation to Bitcoin, which I will never sell. Most importantly, I'm holding 35% cash, 23% straight up cash, and 12% UUP, which is a bet on US dollars going higher and more specifically the euro going lower. And I think this new environment is not good for Europe, and the US dollar will be a safe haven for the time being. And so those are my views, and that's how I'm changing my portfolio. As you can see, I've drastically reduced my exposure to equities, and I've increased my exposure to bonds as well as some agricultural commodities. Now, once again, I don't have a crystal ball, and so I really don't know what will happen. But I think asset prices won't do well this year, and I'm protecting my portfolio accordingly. But I definitely could be wrong, and I'm trying to be and stay open-minded, and so I'm going to be nimble, as nimble as I can be, so I will change my views as new information comes in. Strong views weekly held is important right now. And if you're thinking that you'll just buy and hold, then that's fine too. But keep in mind that there are no guarantees in markets. Saying that the market goes up in the long term has historically been true, but we've seen many periods in history where stocks go sideways for decades. The 1970s are a clear example where you did not want your money in stocks. Commodities and gold in that case were much better. And so this is the game that we play as investors. We don't know what assets will go up in value, so all we can make are calculated bets. By saying time in the market beats timing the market and holding stocks, you're basically making the bet that the market goes higher just as much as I'm making the bet that the market goes lower. So our time horizon might be different, but in the end, we're both making calculated bets. And that's fine for anyone who has given it some thought, but I don't think this is a time to be passive in markets. At the very least, be diversified with some gold and commodity exposure along with your stocks. Or keep holding stocks, just do some of your own research and really understand what you own in your portfolio and why you own it. This is not a time to just buy stocks that you read about on Wall Street Bets or that you see people talking about on YouTube. So I'll leave it at that. I'm being very defensive in this environment, and I would encourage everyone to do the same. But it's important to keep in mind at the end of the day, we're just talking about money here. We may be entering a bear market, and bear markets are usually pretty brutal. They love to make both the bulls and the bears lose money. But in the end, this is just money. Anyone living in a peaceful country right now should be thankful just to have peace. Many people living in Ukraine and Russia just had their world turned upside down, much like so many other innocent people living in conflict. So be grateful for what you have, and don't focus so much on insignificant things like losing some money in markets. We could be entering a very difficult time period, and so let's remember to be grateful and to be kind to each other. So, that being said, stay safe in these crazy markets, and I'll see you at the next video.